Zoom Video was one of the biggest beneficiaries of the pandemic. Between 2020 and 2021, revenue grew over 300%, and the stock soared more than 600%, taking the market cap to $160 billion. Since then, however, revenue growth has slowed to single digits, and the stock price has come back down to earth. Today, the company has a valuation just over $20 billion. With $6 billion of cash and investments and zero debt, the enterprise value is roughly $14 billion. Revenue for the rest of the year is expected to come in at $4.47 billion, which represents less than 2% annual growth. Free cash flow looks good at just over $1 billion, but net income has collapsed from a peak of $1.4 billion in 2022 to just $5.5 million over the last 12 months. That means Zoom's stock is now valued at 3.2 times revenue, 13 times free cash flow, and over 4,000 times earnings. So why is the company reporting such a huge drop in net income? A major reason is stock-based compensation, which totals almost $1.4 billion over the last 12 months. That figure is now 30% of revenue. A second reason is that the company has seen a significant increase in operating expenses. Looking at the table, you can see that R&D makes up 19% of revenue and G&A is 15% of revenue. Nothing strange there, but what is strange is that Zoom is spending $1.8 billion on sales and marketing, 40% of revenue, and it's only achieving modest growth. In fact, sales and marketing spend was up 55% in the first quarter, while revenue increased only 3%. This indicates that Zoom is spending a lot of money to keep existing customers on the platform, and it's a worrying sign when combined with the growth outlook. On the plus side, Zoom has an excellent balance sheet, nice margins, and the company's ability to generate free cash flow means it could become a worthwhile investment at the right price. The problem is that Zoom is still being valued as a growth stock, but growth isn't coming. Management is spending a lot on sales and it's spending a lot on R&D, but new projects like Zoom Phone are not particularly exciting and they indicate a lack of innovation in the company. Technology is rapidly changing and Zoom needs to up its game if it wants to stay relevant in the coming years. Ultimately, without that growth, the valuation is likely to keep heading lower, which is why I continue to give the stock a negative rating. But these are my personal opinions, not financial advice, and I've got no position in this stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.